In the last decade, one financial formula stripped 600,000 jobs from American retail. It was completely legal. It followed the same 7 steps, in the same order, almost every single time. And the men who signed the checks walked away with billions before the stores went dark. This is not a story about bad luck. It is a story about a template. This is Sector Down. Strip away the brand names, and every collapse in this episode follows the same 7 steps, in the same order, almost without exception. Step 1. Acquisition. A private equity firm puts up a small share of the purchase price, often as little as 10 to 20%, and borrows the rest from banks and bondholders. That debt does not remain with the private equity firm. It is ultimately borne by the acquired company and its future cash flows. The retailer that never asked for the loan becomes the one legally obligated to pay it back, with its own future cash flow as collateral. Step 2. The interest burden. Every year, a fixed, non-negotiable payment comes due on that debt. This is cash that would otherwise have gone toward new stores, e-commerce infrastructure, wages, or simply competing with whoever is eating the company's market share. Instead, it is diverted automatically to debt service on a transaction the company's own employees and customers had no say in. Step 3. Management fees. In many deals, the private equity firm charges the company it now owns for the privilege of having been bought annual advisory or monitoring fees that can reach millions, and in some cases tens of millions, of dollars. The fee structure is written into the deal before the ink dries. Step 4. Real estate extraction. If the company owns its own buildings, the private equity firm can sell that real estate to a separate entity, often one it controls, and then lease the buildings back to the retailer at market rent. The company that once owned its stores now pays rent on them. The real estate becomes a parallel, insulated asset, valuable regardless of what happens to the retail business that built it. Step 5. The dividend recapitalization. If the company shows any sign of stabilizing, the firm can have it borrow even more money, not to invest in operations, but to pay a special dividend straight back to the ownership group. The company takes on fresh debt for the sole purpose of paying the people who already profited from the first round of debt. Step 6. Bankruptcy. Eventually, the math runs out. The retailer files for Chapter 11 or liquidates outright. By this point, the private equity firm has frequently already collected its fees, its dividends, and the proceeds of any sale-leaseback, extracted years, sometimes a full decade, before the storefront finally went dark. Step 7. The aftermath. Employees lose their jobs, often with little notice. Pension funds, where they still exist, are left underfunded, with the gap absorbed by a federal insurance program. Vendors go unpaid, or are paid cents on the dollar, and the private equity firm's return on the deal, measured separately from the wreckage it left behind, frequently still looks fine on paper, reported to its own investors as a qualified success. For every dollar these firms put in, the company they bought was typically made to borrow 3 or 4 more. The retailer absorbed the leverage. The firm could collect fees and preserve parts of its upside, while much of the operating downside fell on the company, workers, vendors, pensioners, and creditors. This is not improvisation. It is a sequence refined over decades. And once you can see the 7 steps, you can watch them executed almost identically across 4 separate, famous American retailers. In March 2005, an investment group made up of KKR, Bain Capital, and the real estate firm Vornado Realty Trust agreed to acquire Toys R Us for $6.6 billion. The deal closed that July. The buyers put up roughly 20% of that purchase price themselves, around $1.6 billion combined. The other 80%, more than $5 billion, became debt sitting directly on the balance sheet of Toys R Us. The company hadn't borrowed that money to grow. It had been handed the bill for its own sale. In the years that followed, Toys R Us faced annual interest costs often estimated in the $400 million plus range, with some accounts placing the burden between roughly $425 million and $517 million. That is not a typo, and it is not a one-time figure. That was the recurring annual cost of servicing a transaction the company's own management hadn't chosen to make and couldn't unwind. This was the window when Amazon was becoming a much more serious force in toys and online retail, undercutting prices, building out same-day logistics, capturing the customers who used to drive to a Toys R Us on a Saturday. The company needed to invest in e-commerce, in store experience, in anything that could compete with a retailer that wasn't carrying $5 billion of acquisition debt. Instead, nearly all of its operating income was being consumed by debt service before a single dollar reached a store shelf or a server. Toys R Us wasn't simply outcompeted, it was financially immobilized while the competition moved. In September 2017, the company filed for Chapter 11 bankruptcy. By early 2018, it was liquidating outright. 33,000 employees lost their jobs in a single, drawn-out closure of every remaining store in the country. Toy store workers, who had, in many cases, spent decades there. KKR and Bain Capital, by some accounts, each collected at least $15 million in fees from the deal's first transaction alone, long before the bankruptcy. Some of the firm's own outside investors lost money on the deal. The firms themselves, by most accounts, did not. This is the prototype. Everything that follows in this episode is a variation on it. Eddie Lampert was not an outside raider. By the time the worst of this story unfolds, he was Sears' largest shareholder, its chairman, and eventually its CEO, running the company and serving as one of its primary lenders at the same time. ESL Investments, Lampert's hedge fund, engineered the merger of Kmart and Sears in 2005, then spent the following decade extracting value from the combined company through a series of increasingly aggressive financial structures, spin-offs, dividends, and eventually the company's own real estate. The signature move came in 2015. Lampert split off 235 of Sears' best-performing stores, plus dozens of additional real estate holdings, into a new publicly traded company called Seritage Growth Properties, then had Sears sign leases to rent back the very buildings it used to own. The Seritage spin-off alone extracted $2.7 billion in real estate value out of Sears in a single transaction. Lampert's hedge fund held a large stake in the new company. He served as its chairman too, on both sides of the same lease. It did not stop there. The bankruptcy estate's lawsuit, filed in 2019 after Sears collapsed, alleged that Lampert and his associates extracted roughly $5 billion in value from the company in total, through the Seritage deal, through the spin-off of Land's End, through the spin-off of Sears' hometown and outlet stores, and through dividends paid out over the years, long before the lights actually went out. Sears filed for Chapter 11 bankruptcy in October 2018. Its pension plans, covering roughly 90,000 current and former workers, were left underfunded by roughly $1.4 to $1.5 billion, depending on the filing and date. A shortfall the federal government's pension insurance program was left to absorb on behalf of people who had spent careers behind a Sears or Kmart counter. None of this required Lampert to break a single law. It required only that the architecture of the deal allow the man extracting the value and the man deciding what got sold to be the same person, sitting on both sides of the same negotiating table. That lawsuit did not resolve quickly. Sears and its creditors settled with Lampert and the other defendants in 2022 for $175 million, with no admission of wrongdoing. If Toys R Us is the prototype, outside investors imposing the formula on a company from a distance, Sears is the same formula, run from the inside by someone who never had to leave the building to apply it. Two examples could be a coincidence. What follows is not. Payless Shoe Source was acquired in 2012 by Golden Gate Capital and Blum Capital Partners in a deal commonly reported around $2 billion that loaded the shoe retailer with hundreds of millions of dollars in new debt. Before its first bankruptcy filing in April 2017, creditors alleged in court that the firms had pulled out hundreds of millions of dollars, with some filings and accounts placing the figure above $350 million to $400 million through dividends and related transactions, paid out shortly before the company collapsed under its own debt load. Payless emerged from that bankruptcy lighter, but not light enough. It filed for Chapter 11 again in February 2019, this time liquidating completely, closing every remaining store in the United States and Puerto Rico. Claire's was taken private in 2007 by Apollo Global Management. in a $3.1 billion leveraged buyout that loaded the accessories and jewelry retailer with $2.5 billion in debt almost overnight. More than a decade of interest payments later, in March 2018, Claire's filed for Chapter 11, citing over $2 billion in debt it could no longer service, debt that traced back in a straight line to the day Apollo signed the deal. Guitar Center followed a slightly different path to a familiar destination. Bain Capital bought the retailer in 2007 for $2.1 billion, financed with substantial debt. When that debt became unmanageable, RE's management took control in 2014, not through a fresh buyout, but through a debt-for-equity swap, becoming the company's owner by becoming its primary creditor. Guitar Center staggered through years of near misses and refinancing before finally filing for Chapter 11 in November 2020. 3 firms, 3 retailers, 3 buyouts, more than a decade apart from one another, running the same sequence almost beat for beat. This isn't a pattern because journalists went looking for one. It's a pattern because it was built to be repeated. The private equity industry has an answer to all of this, and it deserves to be stated plainly. We took over companies that were already struggling, often companies the public markets had given up on, and at least gave them a chance to survive. The numbers complicate that defense considerably. Sears was profitable in the years surrounding Lampert's 2005 merger. Toys R Us was generating over $11 billion in annual revenue the year before its buyout closed. A large established retailer, not a hospice case. These were companies handed a debt load they had not asked for and, in most cases, could not safely carry alongside the cost of actually competing. And none of what you've heard in this episode required breaking a single law. Bankruptcy law allows a company to be loaded with acquisition debt and still have that deal close without challenge. Pension law did not require Sears, or its ownership, to keep its retirement obligations fully funded as the company's fortunes declined year over year, and the tax code actively rewards this entire structure. Interest payments on corporate debt are tax deductible, which means the more debt a leveraged buyout creates, the more the resulting company can write off its own decline. This is not a story about a loophole someone discovered by accident. The system did not fail to notice what was happening here. The system was built, deduction by deduction, statute by statute, around the assumption that it would. As Upton Sinclair put it the better part of a century ago, in a line that has only gotten more useful with time, it is difficult to get a man to understand something when his salary depends upon his not understanding it. 600,000, that is the Center for Popular Democracy's estimate of direct job losses at private equity-owned and hedge fund-owned retailers over roughly the past decade. Store associates, stockroom workers, assistant managers, the people who were told, explicitly or otherwise, that working retail meant some baseline measure of stability. Count the suppliers who lost a customer overnight, the toy makers, the shoe factories, the instrument manufacturers who lost a major outlet for their products. And the same research puts the total job loss, direct and indirect combined, above 1.3 million. The real estate tells its own version of this story, and it is not a story of disappearance. Much of it simply changed hands. Seritage still owns what used to be Sears, repositioning the land for apartments and offices, long after the stores themselves are gone. The real estate investment trusts spun out of these deals have, in several cases, outlived the retailers that built the buildings in the first place. The land was never the problem. The land did fine. The workers got a different version of the same event. They got the version where the company says it's restructuring, where the layoff notice arrives dressed up as a market correction, where nobody quoted in the press release is named Lampert, or KKR, or Apollo, or Ares. The debt had a name attached to it the whole time, filed in court documents and SEC disclosures for anyone who cared to look. The job loss somehow in nearly every press release never did. Toys R Us, Sears, Payless, Claire's, Guitar Center, 4 different categories of retail, 4 different decades of American shopping habits, and one identical financial sequence run against every single one of them. None of these companies died because people stopped wanting toys, or tools, or shoes, or guitars. They died after a structure was placed on top of them that made survival dramatically harder, and in some cases, nearly impossible. The next time you see a gate pulled down on a store you grew up with, look past the closing sale sign. Look for the debt, look for the fees, look for the real estate deal that happened 5 years before the lights went out. The formula is still working. It is working somewhere right now, on a retailer whose name you already know, in a deal you haven't heard about yet. And by the time the receipt comes due, the men who signed the checks are already gone.